Welcome everybody to Fides Wealth Strategies Group's first installment of what we're thinking on the markets. As always, we want to thank you for your continued faith and support in what we're doing for you and your families. The point of this video is to really get out to everybody our train of thought, the way that we're thinking right now, what's going on with the market. So let's get right down to it. Let's talk about what everybody's thinking. Chris, let's talk about the election.
Election? What?
Let's talk about the election.
There's something going on
Yeah.
coming up in the next few days here.
Yeah.
Yeah, so, we've gotten this question a lot from clients. What does this presidential election, mean to the stock market, to the economy? If Trump wins, if Biden wins, if there's no answer, which is potentially a possibility this cycle through for a period of days or weeks, what would likely happen with the markets? And so we've been getting this question a lot. And then, of course, there's the possibility that there could be what they're calling a blue wave, where the Democrats would get control of the Senate as well, and then they would have control of the three policy branches, I guess, for lack of a better term. And so we've talked to a lot of different asset managers and looked at their historical analysis on the markets. And what we basically found out is that a year later, sometime down the road, it almost doesn't matter what the outcome is, whether it's a Democratic sweep, a Republican sweep, or a split house between Republicans and Democrats.
There's an emotional tie to it for everybody.
There's absolutely 100% there's an emotional tie, right?
Yeah.
People are concerned. They're going to say, "Oh, my guy or gal didn't win, and so therefore this or that is going to happen." When we think of this cycle, we think it might be a little bit different. We'll get into the economic impacts in a few minutes, but you think about where we are right now. We're in the middle of the coronavirus pandemic. We've been hearing that there might be a stimulus payment coming, but it's still not here yet. As a second stimulus payment, I guess I should say. The election cycle is here. There's just a lot.
Vaccine maybe there.
There might be a vaccine coming. There might
Yeah.
not be coming. So there is a lot more than just the election going on here that we've really been focused on. But I think the thing we want to get across is, based on the research done by a lot of our asset managers we talk to, the outcome is less important for the economy and the market. What might be important is how the different sectors are affected, and that's something your investment team, Mark and myself, and those that we work with are going to evaluate, and we're going to make recommendations and/or changes or actions based upon that. Historically, the first 2 years is a little below average market returns. The next 2 years of a presidential cycle is a little above average returns. The 4 years together come back to something pretty typical. You think through, Mark, the new president gets sworn in January. You have a new Congress in January. It's not like they can wave their wand and change taxes or do this or do that. It has to get through Congress, and policy has to be made, and then it has to have the time to work its way back in and affect the markets. And so it's not something we would expect to see major policy changes on day one that would affect our markets. But let's talk about for a minute, what are the potential outcomes, and let's talk about maybe sectors for a little bit of factors. A Republican win or a Democratic win. What are the likely outcomes?
Well, what's really common when a Republican wins is it's more of a conservative play for a lot of folks. Conservative plays for a lot of folks means maybe defense, energy, financials will sometimes do it as well, and the gig economy seems to be kind of like the big areas for the Republican win. I don't believe there's a red wave on the horizon at all. But if the House and the Senate are split, and you have a Republican president, I would say that's probably kind of the path you want to head down.
Okay, so defense stocks, energy stocks, financials, the gig economy, those types of companies. What about a Democratic win or a blue wave, as they're talking about?
So we're talking about a blue wave, a Democrat wave. Some of the biggest things that people are looking towards right now is digital infrastructure. That's a big one. Green energy, as you can imagine, right? I mean, Biden has been talking a lot about how much money he wants to throw at our economy when it comes to climate change and things of that nature. Healthcare, obviously, they're talking about reforming or trying to maintain. He's talking about Joe Care or Biden Care as opposed to Obamacare. Infrastructure. Traditionally, when we are in a high unemployment and we have a Democrat in office, what you'll see is a lot of legislation pushing towards putting people back to work. I always think of the Great Depression, those kind of scenarios.
On infrastructure, that's something we've been talking about on our investment committee. We actually believe that we may see an infrastructure bill and spending on infrastructure under either Republican or Democratic controlled legislature.
I mean, we've been talking about infrastructure spending for years and years and years and years, right? So I mean, that's always there. And one of the things that people aren't thinking of that's probably not on the radar is firms affiliated with China, because obviously, Republican or Democrat, it's the current administration is not as favorable towards China as past administrations.
Yeah.
So I think that's big to look at. One of the biggest concerns that investors have these days, through the election cycle, is if they sweep, though. If the Democrats sweep, then what you tend to have,
that's the blue wave.
the whole blue wave, yeah. The blue wave is a reversal of a lot of the policies. That's when you might actually see the Trump tax cuts from 2017 get reversed out. That's a big one. You'll start to see a lot of the red tape that Trump got rid of, or the oversight that Trump got rid of. You'll start to see that kind of maybe start to come back into place a little bit.
So anti-regulatory reform, I guess.
Yeah, in essence, your anti-regulatory reforms, those type of scenarios where then it creates again more bottle ups, but I mean also protects people as well. So I mean, there's good and there's bad with that, but that will intrinsically slow the market down as we know it today, for a short period of time.
Yeah.
And then lastly, it might end up being lower stock prices for that period of time, and we just move through it. History shows that the stocks have done well whenever you have these blue waves. It's only happened 42 years in our republic. And it always seems to work itself out. Things that people don't think about is in the event we have a blue wave, traditionally 2 years later we have another election that comes in. And if it's not going the way that people want, they tend to vote them out.
Yeah.
So remember that whoever wins this election, it's one person. It's one person. They're gonna have to get that all the way through. So historically, you might have a least good idea towards the market or a better good. One of the important things I can't stress, and Chris can't stress enough, is don't try to time it. Don't try to jump in, jump out just because of the way that we're going down that path. I mean, what is the Fed talking about? Well, let's get into that.
So that's another interesting point, something we've experienced all year. And this has been a year of unprecedented volatility and speed to our markets, I would say. We spent the last decade dealing with, for all intents and purposes, a zero interest rate environment. And I mean, think back, hopefully you had enough money in your savings account where you got a 1099 on interest that you earned in the last maybe year or two. But prior to that, you'd have to have a lot of money in the savings account to earn enough money for the bank to send you a 1099. And unfortunately, that's back down to the environment that we're in again. And we're in a near zero interest rate environment. And so I guess the good news or the silver lining is that we've been here. It's very recently, and so advisors know kind of the how to play that, if you will.
We're not Japan.
We're not. Well, hopefully
we're not in a negative interest rate environment for what, 10?
Well, they were zero for a few decades. And so that's been a challenge there for them. But so that's something that we're dealing with. But ironically, we've seen a boom in the housing price market recently, and a lot of our clients that refinanced maybe last year, a year and a half ago, are taking advantage of low mortgage rates again, and even starting to refinance maybe a second time. Possibly people are using some of that cash, if they do a cash out refinance, to spend back into the economy. And so we're seeing a pretty strong housing market, maybe as a result of these low interest rates.
I remember in 2010 when the interest rates went below 6, and it was anarchy. When I 2006, it was even 2004. It was anarchy.
I mean, when I talk to mortgage professionals over the last decade or more than that now, we've joked about, well, they can't possibly go any lower, and they just did again. So as a side note, if you haven't looked at your mortgage interest rate lately in the last 6 to 9 months, it may be something to take a look at and reach out to a mortgage professional to see if it makes sense to consider a refinance or just looking at your debt structure.
Now, with a low interest rate environment, what is that going to do for our economy traditionally?
Well, it's typically a relatively good thing, right?
Yeah.
Bottom-up forecasters are predicting record levels of overall corporate profits next year, and we tend to think that we agree with that, I guess. Bottom line is that the rise in stocks is not based on fantasy, but a fact that profits and low interest rates continue to reflect undervalued equity prices for most industries, and so that's basically where we're at.
And all that really means for all of you is that you want to have your investment strategy the way you are. Don't let the political environment that we're dealing with today affect the way that you are thinking long term. Okay, if you're in your 401k, it doesn't mean change the way you're doing things. If you have your investments, we're not going to change drastic moves. The investment committee itself is coming together. We are making adjustments as we need to, minor adjustments here and there to try to make certain that we are not in a volatile or less volatile environment than you as an investor should be. I think that's important to look at.
And on that point, Marcus, so is if we continue to experience volatility, which is our belief, we believe there's going to be volatility probably for the next couple of months. Volatility can be good and it can be bad. It can be an increase or a decrease in market values. You want to ask yourself, am I still on pace with my plan? Am I comfortable with the risk that's taking when markets go down? You're never comfortable, right? No one feels good with that. When they're going up as they have, and they're up this year at this point, that's a good thing. It's comfortable. It's good feeling. But what is my goal, and am I still in line with my goal? And is going to something more conservative, what type of effect will that have on my long-term goal? Those are the questions to be asking yourself.
I think people got a real good gut check in March as to how they can handle volatility. I know through the last 10 years in the market going consistently in the upward trend, people got a little complacent with risk. Mm-hmm. So it's important to understand. I think people had a big gut check in March as to where they were at there as well. Now, what's the investment committee leaning towards going forward?
So there's a few different, and I kind of teased that at the beginning of this video. There's a few different things we're focused on. Obviously, the outcome of the election. And when I say obviously, there not so much that the outcome is that important, but that we may make adjustments to sectors based on the outcome and the likely policy that would come from that. I think the bigger question mark, though, and what everyone's focused on is the coronavirus, and when are we going to have a vaccine? Are we going to be seeing shutdowns again here in the United States? We're already starting to see those. It's being reported in Europe, and so what does that mean? And what's that going to look like? If we get a vaccine relatively soon, and people get inoculated, and the forecasters say, hey, 6 to 9 months, we may be back to whatever normal is. Right. The market will probably see that positively, and so. And it's not that we need to wait until the time that we see all the way through to the end.
That'll be too late.
Things are back to normal. You got to remember that investors are always looking, they're forecasting earnings 12 months out, and so the market should react positively, one would assume, to news of what that timeline looks
with
like.
Stimulus coming in, things of that nature, as those get funded, obviously that's going to stimulate the economy, and by the time that actually hits the economy, it's already too late. The easiest way to bring that in.
Yeah, the investors have already
bought it. Yeah, absolutely.
We mentioned interest rates earlier. That is a big concern. The Fed has come out and it sounds like they're going to keep them low for a very long period of time. And so what does that mean to our fixed income returns? We have a lot of retired clients, and so that's something we're very focused on. But again, we saw this playbook a couple of years ago over the previous decade, and so just re-looking back at that, and how do we adjust our portfolios if they need adjusting based on the interest rate outlook. I think their potential of continued civil unrest is something we're paying attention to. We don't anticipate that to have major impacts on the market.
But long term.
But it's certainly something that we're focused on, I guess. Some of the different areas that we're looking at and things and factors that we may change. We've been having a value versus growth stock discussion. We're kind of even on 50-50-ish, I would say at this point there. Do we lean more towards value, more towards growth? That's something we've been contemplating. Something that I've been thinking a lot about is with a huge additional spend, the stimulus spending this year, and a big deficit spend last year. The federal debt being somewhere in the $26 trillion range now. What does that mean for our economy a decade or 2 decades or 3 decades down the road, especially given that Social Security is going to have its own challenges as we get into the 2030s, or the most recent projections I've seen there. So, what does that mean? Does that mean higher inflation possibly? Does that mean higher taxes possibly? We think either of those are possibilities down the road, not immediately, not like in the next few months. We think that's something that we'll be looking at.
I believe it's a stay tuned for that one. I think that's going to be one of the biggest reasons we're going to continue to do things like this, is to make certain that we keep all of them informed as to where we're going.
Yeah.
And more importantly, understand that we're watching these type of things. We're looking for where we can get the value for you as an investor. So I want to thank all of you for all your continued support, for everything that you're doing, and feel free to give us a call if you have any questions pertaining to where this video is. If you want to share it with others, let us know. We can send it to them directly.
Yep.
Thank you for your continued faith and support.